For many people, paying off a mortgage feels like the ultimate financial win. It represents discipline. It represents success. It represents peace of mind. You imagine the moment clearly. No more monthly payments. No more debt. Your home finally feels yours. And emotionally, that feeling is real. But financially, this decision often hides risks that almost nobody talks about. The feeling of safety versus actual safety. Most people confuse feeling safe with being safe. A paid-off house feels safe because there's no bill attached to it. There's no lender calling. No interest being charged. But real-life safety depends on something else entirely. Access to money when life goes wrong. Emergencies don't wait for pride or peace of mind. They demand cash immediately. What happens to your money when you pay extra? When you send extra money to your mortgage, that money doesn't disappear, but it does change form. It turns into home equity. Equity looks great on paper. It increases your net worth. It feels productive. But equity has a major weakness. You can't easily use it. You can't swipe it at a grocery store. Use it to pay bills. Fix a car with it. Cover rent or medical costs. Once money goes into the house, it becomes locked. The house rich, cash poor problem. This leads to a very common situation. Someone owns a valuable home. On paper, they're wealthy. But in reality, their savings are low. Their emergency fund is gone. Their monthly flexibility is tight. If income stops, stress hits immediately. This is what people mean when they say house rich, cash poor. It's not a rare problem. It's incredibly common, especially among people who rush to pay off their homes. Why banks do save you when you need them? Many people assume, if I need money, I'll just borrow against the house. In theory, that sounds reasonable. In practice, it often fails. Banks lend based on income, stability, market conditions. If you lose your job, face health issues, or enter recession, banks become cautious. They lend money to people who don't need it, not to people who do. That means your equity may exist, but you still can't access it. What risk actually means? Most people define risk as having debt. But in reality, risk is not having options. Debt with liquidity gives you flexibility. No debt with no cash gives you fragility. A person with a mortgage, savings, investments, can survive job loss, emergencies, and downturns far more easily than someone with no mortgage, no liquid money, because one person has room to move. The real return of paying extra on a mortgage. Let's simplify the math. If your mortgage rate is 4%, then paying extra gives you a guaranteed 4% return. That's it. Now compare that to alternatives. Cash accounts often earn close to that. Long-term investing historically earns more. By choosing extra mortgage payments, you are choosing the lowest growth path for your money. It feels safe, but it limits future wealth. Why this advice used to be right? This confusion didn't come from nowhere. In past decades, mortgage rates were very high. Debt was dangerous. Paying it off quickly made sense. That advice saved people back then. But the financial world changed. Interest rates dropped. Investment access improved. Inflation became a major factor. Old rules don't always work in new systems. Inflation quietly works in your favor. Inflation sounds scary, but for long-term fixed loans, it can help you. Your mortgage payment stays mostly the same. Your income usually rises over time. The value of money slowly falls. That means today's payment feels heavy. Future payments feel lighter. Over decades, you repay the loan with less valuable dollars. If you pay off the mortgage early, you remove this advantage. You give the bank strong dollars today instead of weaker dollars later. Opportunity cost, the wealth you never see. Opportunity cost is what your money could have become. Extra mortgage payments don't grow. They don't compound. They don't stay accessible. Invested money does. Over long periods, the difference between paying off early, investing consistently, can become massive. This lost growth is invisible, which is why many people don't notice it until it's too late. Why a paid-off house doesn't mean freedom. Many people believe, once the house is paid off, I'll finally be free. But life doesn't pause. When payments stop, lifestyle often expands. Spending increases. Investment discipline weakens. Instead of investing the freed-up cash, people often absorb it into daily life. Keeping structured payments can actually protect long-term discipline. Liquidity creates calm. Liquidity means cash, accessible investments, emergency funds. Liquidity allows you to sleep better, take risks, say no to bad situations, handle emergencies calmly. A house alone doesn't do that. Liquidity is what turns financial stress into financial confidence. When paying off early makes sense, there are cases where paying off early can work. It may make sense if your interest rate is very high. You truly can't invest consistently. Debt causes severe emotional stress. Money decisions are not only math, emotions matter too. But for disciplined people with low-interest loans, aggressive payoff often creates more risk, not less. A more balanced strategy. A smarter approach usually looks like this. Pay the regular mortgage. Build strong savings. Invest extra money. Maintain flexibility. This way, you grow wealth. You protect yourself. You keep options open. You don't need to rush to zero. You need to build resilience. The big idea to remember. A paid-off house is comforting. But comfort isn't the same as security. Security comes from access to money, multiple options, flexibility during hard times. Before sending extra payments, ask yourself, would this money help me more if I could still reach it? That question alone can change your financial future.